Yes.
Great.
Yes, I can see your screen.
Okay, okay, that's great. That's great. Also, so basically, I'll just start off with the basic introduction. So I'll just walk through the different topics that we have covered, right? And then we'll start talking about what we are doing. So over here, Suchi, these sessions are over and above the DexLab facilities, right? So I, apart from DexLab sessions, I also freelance on credit risk as well as SaaS, CRM, etc. All these areas. So this is such a session, and hence all the all the links and all everything would be sent independent of the DexLab IDs, right? So uh, this is what the sessions are, and the syllabus that I have for this session is a little revised syllabus. I'll just show you what the syllabus over here looks like. So it's a more crisp syllabus that I have. So it's more or less the same kind of, it's more or less a similar kind of CRM sessions, and the syllabus more or less remains the same. So it is just that the framework has changed a little bit. Yeah, just a minute. So over here, we start off with basic, with these basic portions first. Then we go into the statistical portions, and then we talk about risk scorecarding, Basel, and the other core modeling areas, right? So this is where the syllabus is just a little different from what the TextLab CRM syllabus is. But it's as far as content is concerned, it covers each and every topic, whatever I covered during those regular sessions as well, right? So this is what it is. Now, having said that, what I have over here is I just started talking about what is risk management, and like what is credit risk, what are the different stages of a customer's credit cycle. Like right from the origination, we start talking about that who is like basically we start talking about that who is a good borrower, who is a bad borrower, whom to give the loan, whom not to give the loan, and from there we start. Once the loan has been granted, the next thing that we start doing over here is we start understanding that who is or how the borrowers behave, right? So basically, we start developing behavioral models like account management, willingness, etc., etc. So apart from there, at the behavioral stage, the question that we generally tend to ask is that how likely is a borrower to default, right? So if a borrower like to default, should collections be initiated and so on. So these are some of the things which generally happen, right? So basically, a customer's credit life cycle begins with origination and it terminates with either closing the account or going into collections and then finally going into write-offs. So this is the overall idea of, or this is what the customer's credit life cycle was. And at each stage of the life cycle, there are certain questions that we try to answer. Say, for example, at the origination stage or at the acquisition stage, the question that we intend to ask uh, is the borrower a reliable borrower? Second, is the borrower an affordable? So, can the borrower afford the credit product? And even if he can afford easy or reliable borrower, so can I actually bank upon him? So, this is what we actually try to do. Now, and at each stage of the customer's credit life cycle, we build up different models which help us assess the credit risk, right? Okay. Now, the next question that we started answering over here was the bank's portfolio. So basically, what are the different components of the bank's portfolio? So basically, broadly there are two types of products. One is the retail product, the other is the commercial products. Now, retail products are products which are designed for the households or for people like you and me, right? Say, for example, products like credit cards, overdrafts, home loans, personal loans, auto loans, etc. And for commercial portfolios are the portfolios which are, you know, which comprise of loans given to the SMEs and the corporates. So basically, we just give it to the firms. Now, at a firm level, there is again a distinction. So you can have a SME as the firm can be an SME, that's small and medium scale enterprise, or you can lend it to big corporates as well. So they are defined in terms of the assets that they hold, right? So SMEs and corporates are distinguished or divided, or rather classified basis the amount of assets that each of them respectively hold, right? So basically, these are at a very broad level, these are the two different kind of portfolios, right? Now, over here, the low default now commercial portfolios are generally seen to be low default portfolios. Why? Because commercial portfolios have relatively small number of accounts compared to the retail outlets, right? Or to the retail loans. Therefore, what happens is a small number of accounts and specific loans. So basically, what happens is small number of accounts, but uh, the exposure of each account is actually very large, right? The number of observations in corporates is even smaller than that in SMEs. Say, for example, loans, so bad loans which were given out to, like, in India, so there has been the news of Nirav Modi and Malia, like not paying back the loans and going off, creating a buzz, right? So they were big corporate loans which were given. And when they were unable to pay back, they just defaulted, thereby creating a huge exposure. Not that all corporates default, it's just that one or two who defaults. Therefore, in terms of the number of accounts which have defaulted, these are low default portfolios. However, the commercial accounts or the commercial products that we have over here, right? So for that's a characteristic of a commercial product. That is, number of accounts in the portfolio is small, but the exposure per unit of the account is very large, right? So over here, in the we made a list of the basic retail products which are generally available, right? So we talked about that the retail products are divided into two parts. One is a revolving credit product. Next is the mortgage product. Third are the other retail products. The revolving credit products or the open-ended products are credit cards, overdrafts, and other form of current accounts. Mortgages and other retail products are mostly closed-ended products. Let's just hold on a second. I think. Just someone. Okay. So as I was saying, yes. So basically, what happens is in farms. So basically, if I have farm, so if sorry. Just give me a second. Okay, so as I was saying, that in the retail products, right, there are these two broad type of lending products. One are the open-ended products, and second is the closed-ended products. Now, within the open-ended products, so we have mostly the revolving products. Now, revolving products are called the open-ended products because these products do not have any maturity time. So you are actually taking money, you are paying it back, you are releasing some limit, and then you are again using it. So that is the way it works, and hence it's called a revolving credit product as well. Similarly, on the other hand, what we have is mortgage products and other retail products which are closed-ended products because there is a definite amount of credit which is taken, right? And that amount of credit is actually repaid back over a span of time. So there is a definite maturity and there is a definite, cutoff on the payback of the loan. So that is what is other. So that is what a closed-end product is. So a closed-end product, credit product, has a definite time for maturity, whereas a open-end product does not have any such maturity. Right. So that is one of the biggest distinction between the two. Now, uh, like the credit portfolio has different kind of credit products. There are also different varieties of commercial lending products as well. So, what are these commercial lending products? So, basically, some important commercial lending products are one of the most important way of this product is direct lending. It's direct lending. The second is factoring. Then there are other different forms of uh, you know lending processes like so one is factoring. Then you have other ways of lending like equipment finance, vehicle finance, etc. You have equipment finance. Then what you have is other form of commercial lendings like one is equipment finance, the second is your say franchisee finance, there are equipment finance, there is vehicle finance, and etc. So like equipment finance, vehicle finance. So vehicle finance is the you know so vehicle finance or it's also called fleet finance, right? So these are different ways of financing the commercial products. So basically, say there is a person who wants to start a transport business, and for that he is actually purchasing a fleet or a set of vehicles. So a trucks, something like that, and hence that finance that is given to him is ton against the amount of number of trucks that he is actually buying. So the trucks, this physical volume of trucks are used as collaterals for giving out these loans, right? Now again, there are different kinds of within direct lending. There are different kinds of products, right? So one of the lending product that we talk about is essentially known as the asset-backed loans or asset-based lending, ABLs, asset-backed loans, right? The second that we have over here within direct lending is the cash flow loans. Cash flow loans, right? Now, within this cash flow loans and asset backed loans, there are different types of lending products, there are lending techniques, right? So, the overall lending techniques of these two are number one is revolving credit or revolving loans, very similar to what credit cards are, but the product is designed in a different manner. Right? So, there is revolving loans, or as they call it, revolver, and term loans. Term loans, revolvers, and term loans. Now, within factoring, there are different factoring products as well. One is recourse factoring, and the other is non-recourse factoring. And non-recourse factoring. So similarly, there are other different kind of products for equipment finance and vehicle finance as well. Right. Now, apart from this, so basically, so these are the outline of different products, right? So now there are different lending processes, there are different lending agreements, then there are different factors, etc.
Sir, I have
Yeah,
a question.
yeah,
So what is factoring?
yeah. I'll come to that. I'll come to that, Harpreet. I'll take up each of the. So
Okay.
that is what we'll do next. I'll take up each of these products.
Okay.
We'll start on from the retail. We'll take up each of the products. We'll take up revolving credit products, mortgage products, other retails. We'll explore what these products are on at a very broad level. Then we'll talk about how these products are, I mean, how do the sources of risk, what are the sources of risk for these different products. Then we'll go to the firms, I mean, to the commercial portfolios, and we'll talk about them as well. Right. So there are these, so we will take up each of these products and we'll discuss. And when we do that, we'll talk about each of these lending methods, both for retail as well as for commercial portfolios. Right. So we'll take up each of them. That is, so just wait. I'll just discuss each and every of the topics of these products. So let me just start off with retail. So I'll start off with retail because retail is something which we can actually, very, I mean, identify with it very easily. So one of the thing that we have over here is the revolving credit product. So let's start off with revolving products first. So when I start talking about revolving products, right? So revolving products, or these products are so called because you do not have any amount of uh, fixed maturity that is to be maintained. So basically, I have a set of a revolving product. So basically, your credit revolves, right? So what does revolve mean? Revolve means something which goes out to one and comes back, right? So that's a revolving kind of a thing. That's why, you know, there's a particular kind of a gun called a revolver. So the bullets keep on revolving. So basically, one, two, three, four, five, six, and then you again come back to the part. So it completes a full circle. So similarly, for revolving products, the most important, or the the most important characteristic is that it is open ended and it does not have a maturity of paying. So it does not have a maturity. It does not have maturity. So it does not have a fixed maturity or a terminal time period. So you can keep on using this product till eternity. So basically, the maturity of the product does not exist. You can use the product till in eternity. Use it till eternity. But the only condition is that there is a limit to the amount of credit that you can use on this particular card or on this particular instruments till eternity. Now, when I talk about using this till eternity, the next thing that I also need to understand from here is that now when I talk about using it till eternity, uh, so basically, but the limit of credit is not infinite. So the limit of credit, but the credit that I have is limited, right? So there is the existence of limited credit. Now the idea over here is that you can actually use the maximum of this limit. So the maximum of the limit which is given to you, and you need to pay that money back, and then again only can you use it. So the limited credit. So basically, what you need to do is you need to pay back the used credit, pay back credit used, and then use it again. Pay back and reuse. Pay back and reuse. So basically, there is a limited credit. So basically, say every credit card has a limit which is given to it, right? And once you use that limit, then you cannot use the card anymore. So what you need to do is you need to pay back the credit first, whatever you have used or a part of it which you have used, free up some limit, and then again use it. So this is the way it ideally goes on, right? So basically, what happens is you use it. You have if you have a revolving maturity, you use it till eternity. You have limited credit, then you take the payback and reuse, right? So this is what the overall idea is for any revolving product in general. And within that, there are two things, or within the revolving product, we have two broad product types. One is credit cards, and the other is overdrafts. Credit card, and the other is overdrafts. Overdrafts. Right? So there is credit cards and there is overdrafts. So this is what the idea is, right? Now we'll take up each of these products one at a time. So let's start off by discussing about credit cards. So the first question that comes out is, what is credit card? What is a credit card? So a credit card is basically a instrument. So it's a credit instrument. It's a credit instrument. Now what does this credit instrument do? This credit instrument promises you a payment of certain credit amount, right? So this promises you a payment or a loan, so to say, right? So if I am actually using my credit card, I am using a loan. So I am taking the money, I am using it, and in turn, I'll be paying that money back to you after a given cycle. So obviously, credit card is a loan. Also, given that it's an unsecured loan, the rate of interest on credit cards are relatively higher. Given that this is an unsecured loan, this is an unsecured loan, therefore, the rates of interests are very high on credit cards. The rate of interest is very high on credit cards. In fact, credit cards are considered to be the most expensive loans given by the bank. It's considered to be one of the most expensive loans given by banks. It is treated as the most expensive loans given by banks. Right? So over here, the next part that we need to do is, or the next part that we need to understand is, so basically, before developing any model or before you go to develop models, a very important characteristic or a very important, a prerequisite is you know what the product is, right? So what exactly are the characteristics of the product, and that is what will help you develop your model. That will help you capture the essential sources of risk, right? So when I talk about this case, when I talk about this model and all, so the first question that comes to my mind is that what is what are the most important characteristics of a credit card? So what is it that makes credit cards so different from others? So basically, the two most important characteristics of a credit card as a business product are: number one is the balance and the limit. So one very important concept of credit card is balance, and the second is limit. Balance and limit. So what is balance and what is limit? So limit is the amount of credit that you are given access to by the bank. So limit is the amount of credit that the bank gives you an access to. Credit to which the account access to has access to. Credit to which the account has an access to. So, for example, if you are given a card, you are given a limit along with it, say 50,000, 60,000, etc. So that is what the credit is. And balance is the actual expenditure that you make, or the amount spent on the card. Amount spent or used on the card. Or used on the card. Right? So these are the two most important characteristics. Now from here, there are two things that we can actually define. There are two important concepts which can be defined from these balance and limit. So what are they? So one very important concept that we can define from here is utilization. So what has been the utilization on the card? So this is where we talk about utilization. So utilization is comprised of two parts. So utilization shows that how much of the balance has been used relative to the amount of limit that was granted. So basically this is limit, and the numerator what you have is balance. Balance by limit into 100. Right. So utilization is balance by limit into 100. So what does utilization show? It shows the amount of balance which has been utilized by the bank and by the borrower. Right. Say for example, uh, in a given month or till a given month, what you see is that the a given limit or allowable limit or the approved limit on the card of a person is 50K. So also this guy has a card amount of 50K, right? And what this guy has done is he has used up around, say, used up 20,000 on the card. So that is 20K. The utilization is 20 divided by 50 into 100 is equal to, is equal to 40%, right? So this is 20 by 50 into 100, which is equal to 40%. Now, so this is basically what the idea is. So utilization, so using balance and limit, we can define utilization, and utilization will give me an idea about how much or what exactly is the overall usage or what is the usage tendency of this particular person on the card, right? So this is what we talk about, or this is what, so this is what is the basic idea when we say, or when we talk about utilization, right? So utilization is used to capture the usage that a person has on the. Now basically the so another important characteristic can be defined from this utilization, which is called headroom. So what is headroom? Headroom is the balance which the borrower can now use for, you know, the borrower can now use. So basically, headroom is, or rather, it is the amount of limit which is left back for the borrower to use. Say, for example, when I talk about this headroom, it is nothing but limit minus balance. That is the unutilized balance of the limit, or it is as we call the undrawn exposure of the bank, or this is the undrawn limit that the person has, the undrawn credit. So with credit cards, there is a problem of a drawn credit and an undrawn credit, and riskiness might arise from both. So over here, this will be 50K minus 20K. Right. So basically, utilization shows us that what is the percentage of amount, you know the percentage of limit that has been used up. So that's the drawn exposure. So basically the person has used this part amount, and I know that okay, this has been the amount used, this has been the payment on this amount, this is what it is. So this is a very observed behavior, and I know how this drawn exposure is working around. But also the risk might arise from this undrawn exposure, because when the guy has not drawn it up, right? So when the guy has not drawn this, the guy knows that, or the bank knows that before, just before defaulting, if he decides to default in the tth moment, just in the t minus 1th moment, he might just draw that amount, the headroom that is left, and then he might go into default, right? So when you are assessing credit cards, when we are assessing the riskiness associated with credit cards, the riskiness arises from the drawn limit or the drawn credit as well as the undrawn credit. So this is called a drawn, the exposure to the loss arising from the drawn credit is called the drawn exposure, or exposure from the drawn balance or drawn limit. This is the drawn exposure. This is the drawn exposure. And the headroom gives us an idea about the undrawn exposure to which the bank might be exposed. So, undrawn exposure. Undrawn exposure. Right? So, the riskiness might arise. So, this is, the challenge of modeling riskiness for credit product, for these revolving credit products, because the riskiness might arise from both these ends. The riskiness. So that is what I'm saying. The riskiness might arise from both the ends. Right? So is this part clear? Harpreet, Suchi, are you guys clear on this part?
Yes,
Yes.
Tanmay.
Okay. Okay. Just hold on a second, guys. Sorry. Great. So this is one of the most so this utilize. I mean the balance and the limit. So this characteristic is something uh, which is really very important for these products, for this credit products. Now the next thing that comes up over here is the following: that if I have you know so what are so how does riskiness arise from these? So how is it that by looking into the utilization, just by looking into the utilization, I cannot decide upon the riskiness of a borrower. So I might be a borrower who is, a very high, who has a very high usage of the credit card. But that does not necessarily mean that I will be a borrower, I will be a bad borrower. What it essentially means is that I have a high utilization of the credit card. And now, vis-a-vis, this would imply that to assess the riskiness for this credit card product, we need to not only look into the usage patterns, but also we need to look into the payment patterns. So as analysts, we need to understand that how does the payments, or how does the payment pattern of the borrower go on, or how has the borrower been paying back the credit over time, right? So this is what the concept of payment pattern is. Now, while talking about the payment on credit cards, there are two ways. One is you pay back. So one is a minimum payment. So every payment cycle, you need to make a minimum payment. So which is say 5% of the total balance outstanding. So there is this minimum payment that you need to make. And secondly, what you also need, and another is payment which is greater than the minimum payment. So basically, you just pay a certain amount which is much greater than the minimum payment as well. So what I also do is I make a payment which is greater than minimum payment, greater than the minimum payment, payment greater than the minimum payment, right? Now over here, the next thing that we need to do is uh, so when I talk about payment, so basically what are these two? Now if a minimum payment is a payment which is 5% of the outstanding balance, so you just need to pay back 5% of the outstanding balance and you can actually revolve your credit, right? 5% of outstanding balance, right? Also, what happens over here is that I have a minimum payment, and if my payment is greater than the minimum payment, I can either pay the full balance that has been outstanding, or I pay an amount which is like more than the minimum payment but less than the entire amount. So I want to keep some amount to be revolving, right? So over here, and delinquency will occur on this card if I pay a amount which is less than the minimum amount. So if the payment that I make is less than the minimum payment, then I become delinquent. Then this is called delinquent. Delinquent. Now, what is delinquency? So delinquency is nothing but is the event of missing out payment on a given installment. For credit card, it is like missing out the minimum payment for a given payment cycle. So generally for credit cards, we do not have installments. What we get is payment cycles. So basically, so payment miss outs. Payment miss outs in a given cycle. In a payment cycle. So this is what is delinquency. So if in a particular payment cycle I miss out on the minimum payment for a credit card, then I become delinquent, right? And if my delinquency sustains for some successive cycles, then I will become a bad borrower, right? So for credit cards, so for assessing the behavioral side of the models, right, understanding the delinquency pattern is also very important. Like we need to know that which are the accounts like has been, so for a given set of origination, we need to know that how many accounts actually went bad, how good went good, and how many of them has been delinquent, what has been their delinquency pattern. Therefore, for risk modeling, delinquency behavior is something which is very important, right? So the term is delinquency. So is this concept of delinquency clear to you all? I mean, are you clear with this idea of delinquency? Because it is basis this delinquency which will decide on how good or how bad a particular borrower is.
Yes, it is clear to
Mm,
me.
Okay.
yeah, it is clear.
Okay. So basically, whenever we start talking about the bad definitions going forward, so this concept of delinquency will be coming. Now, talking about credit cards, there is another concept of payment cycle, right? So generally, for when we are working with a data, right, when we're working with the credit card data, we need to ensure that whatever we are doing, right? So whatever you know data is being collected, the data collected ideally should be a cycle end or a statement end data rather than a month end data. So this payment cycle for credit cards is actually very important. Cycle end, or as we call it, a statement end data. So for us, for those of us who use, credit cards, you would know that there is some kind of uh, behavior. So basically, so at the end of every month or on a given date on a month, you get a statement, right? So after that statement, what happens is there is a bill which a bill comes up, a credit card or a bill comes up. So that's the cycle. That marks the end of a cycle, or that's a statement end data. So at the end of the statement, what you have is a balance that is mentioned for that given cycle, and it shows all the purchases and transactions that you have done on that. And from there, what you do is you just use this. So basically, what happens? So what you do is you just use the card, right? So basically, at the end of, say, on the 25th of every month, there is a bill which is generated. And if you had taken the credit card on the 25th of the month, so the statement will come to you every 25th of the month, right? Now, if so, when the day when the bill comes to you, so from there, you have a payment cycle, right? So you have some amount of time which is given to you in order to pay the bill, which is generally around 15 to 20 days. So there are 15 to 20 days of time which is given. Now, if within that time you do not pay the bill, then onwards you start becoming delinquent. Say, for example, on every month, right, your bill is generated. So bill date is, say, on the 15th of every month. Say your bill comes in on 15th March 2018, right? So bill comes in on 15th March 2018. Then again it comes on 15th April, 15th May, like this. And your payment date is on the 5th of April, on or before 5th of April 2018, right? So what we have is the bill date and we have the payment date. So now, if I within this date, so on or before 504, right, I need to pay back the minimum balance. I need to pay back the minimum balance. So when I pay back this minimum balance, right, then I know that, okay, I have actually paid back the minimum balance and I have avoided delinquency, right? Now, if I do not pay that back on the 6th of April, on 6th of April, I become 1 day delinquent. On 6th April, on 6th April, I'll become 1 day delinquent. 1 day delinquent. Clear? Now, if from the 6th April to the, if for the next 30 days you do not pay back, then you become 30 days delinquent or one cycle delinquent. So if you miss out the minimum payment of one given cycle, then you become one cycle delinquent. Right?
Okay.
Okay, great. Now understanding this delinquency is very important because for so when I am trying to assess the riskiness associated with credit cards, right? So there are, so this date variable is something which is really very important, right? So that's one part. Now let's understand that what are the different sources of acquisition risk and origination risk, behavior risk, and how does these risks arise for credit cards. So along what lines should I be assessing those risks for this particular credit product, right? So this is something that we need to understand. So this is something that we will be assessing over here, right? So as we go on with this, so let's start an understanding what are the acquisition risks, or how does the acquisition risk or the origination risk arise for credit card, and how is it that acquisition scorecards or acquisition models will help us assess the behavior, the origination risk with credit cards. So basically for credit cards we will try to assess the different sources of, for credit cards we'll try to assess the different sources of acquisition risk and origination risk. So basically we look into the acquisition risk and the behavior risk. Acquisition risk. The second that we look into over here is the behavior risk. Now trying to understand acquisition risk. So what is acquisition risk? So acquisition risk or origination risk would arise when the bank is trying to acquire the customer on the books of the bank. Right, when the customer is trying, or when the bank is trying to acquire the customer on their books. Now, when credit card customers are being acquired on the books, right, there are broadly two types of borrowers, or there are two types of accounts which are acquired. One are the relationship accounts, one are the relationship accounts, and the second is the non-relationship accounts. Second is the non-relationship accounts. So what is this relationship account and what is this non-relationship? Now, a relationship account is one which maintains a relationship balance with the given bank, right? So, relationship account is one which maintains a relationship account, or a, it's a relationship account is one which maintains a relationship balance with the bank. Now, again, relationship accounts can be divided into two parts. One is staff accounts. So the very fact that this guy is a staff with a company whose account is in this bank, ensures that this staff or this guy is not going to run away. So there is this staff account, and the other is non-staff or customer accounts. The other are the customer accounts, which basically say, suppose I may not be working with a company whose account is in, you know, I mean, whose account is in Citibank, but I myself as an individual might have an account with Citibank. So those are customer accounts. Also, it might be that the bank with which I work or the organization with which I work has their salary accounts in Citibank. So then I fall under staff accounts, right? So over here, the relationship borrower might be divided in two parts. One is a staff account and the other is a customer account. However, staff accounts are mostly salary accounts, and hence there may not be a relationship balance limitation. However, when there is a customer that is there, right, the customer will actually have, so the customer will actually have will require a relationship amount. So a relationship amount is an amount of demand deposit, is a minimum balance of demand deposit which a customer maintains with the bank. So it is a minimum amount of demand deposits is a minimum amount of demand deposits which the borrower or which a customer maintains with the bank. Which a customer maintains with a bank. Maintains with a bank, right? So there is a minimum amount of demand deposit which a customer maintains with a bank. Now, when this happens, so over here, when I so basically for these relationship customers, right? So a customer who maintains a relationship amount with the bank. Now, what is the importance of this relationship amount, or what is the importance of this demand deposit? So it is not only that it has to be in the form of a minimum savings balance, but it also has to be in, or it can also be in terms of any demand deposit like fixed deposit, recurring deposit, etc. In terms of all these, what you do is you keep aside a bank. So basically, what you do is you keep aside a, you keep aside what I call is a basic minimum demand deposit. So if so, what is the intention behind this demand deposit? The intention behind this demand deposit is to ensure the riskiness of the borrower, to filter the riskiness of the borrower. So basically, if a borrower can maintain the minimum demand deposit by the conditions of the bank, then the bank knows that this guy has the capacity to maintain this deposit. That means his affordability is much above this because he is maintaining this minimum demand deposit which he cannot touch. That means his uh, capability or his affordability for any given product X is above this minimum amount, and hence he can actually afford that. So for example, in HSBC, If you want to maintain an advance account with the bank, the minimum amount of the relationship balance you need to maintain with them is 5.5 lakhs, right? And then if you ask for a credit card, the bank would be more than happy to give you the credit card because they would know that, okay, this guy has the capacity to maintain this particular product, maintain this particular term deposit. Therefore, if I give him a credit card with 2 lakhs a month, or 2 lakhs, he can actually use it up, right? So that is something which is important, right? So this ensures that the relationship amount ensures a minimum level of affordability for the borrower, ensures a minimum level of affordability, a minimum extent of affordability. A minimum extent of affordability. Now, if the borrower can maintain this, so it simply means that this borrower is a relatively low risk borrower. So, if the guy can maintain this balance, then what I can clearly understand is that this guy is a relatively low risk borrower because he at least has the affordability of taking the product. Really low risk. We have relatively low risk borrowers. Now, given that these are relatively low risk borrowers, therefore the bank will always be willing to give the credit card to a relationship borrower or to a staff account, right? So basically, so over here, obviously, banks are always willing to give the credit to these borrowers. The reason is that number one, this borrower maintains a minimum amount of credit balance with this particular bank, right? The second is that there is this borrower who is, this borrower has the affordability to maintain because uh, he maintains that minimum relationship balance with the bank. The second thing over here is that the borrower is willing to, or this borrower is, what should I say, that this borrower is like, uh, so this borrower is a person who has already banked with this particular organization, right? And given that the borrower has banked with this particular bank, has been in a banking relationship with this bank, the bank also has a very good idea about his probable behavior. That is why uh, the banks are always willing to give a particular credit. The banks are always willing to give out a line of credit to these people. So, and hence it is easier for a relationship borrower to get a credit card than a non-relationship borrower. So, willingness to give credit. So, basically, the willingness for the bank to lend credit is very high for these borrowers. to lend credit is very high for these borrowers. High for these borrowers. So basically, it is generally seen that during downturn periods, right, it is the relationship borrower who gets the credit, but not non-relationship borrowers. So the willingness to high is to give credit during downturns, during normal times. During normal times, second is during downturns. During downturns. So no matter what time of the business cycle it is always easy for, it always helps us get this. It always, it is always easy for banks, or it is always reliable for banks to the lend out to the non-relationship customers, right? I mean, lend out to the relationship customers because they maintain a minimum amount of deposit with the bank, and secondly, they have been having a banking history with the bank, which makes it easier for them to do it. Okay, so clear up to this part. So basically, yeah,
Yes.
okay. So basically, at an acquisition stage, a major source of riskiness arises from the origination channel of the borrower. So whether the borrower is a relationship borrower or is he a non-relationship borrower, that is something which will define the behavior of this thing. I mean, which will design this acquisition strategy. Now, if a bank is indiscriminate and indiscriminately it lends to non-relationship or relationship borrowers, then it is, there are high chances that non-relationship borrowers would default, because mostly it is seen that non-relationship borrowers, because since the non-relationship borrowers do not have any kind of, information. I mean, they do not have any kind of minimum deposit, etc., with the bank. Therefore, it becomes very difficult for the bank to work with them, right? Hence, what we get to see is that because the bank does not have any sufficient information about their historical behavior, they might end up misjudging, I mean, wrongly judging them on their capacity, and hence that might create a problem going forward, right? So over here, during downturns of be it whatever point of time, relationship borrowers are always favored corresponding to non-relationship borrowers. Now, non-relationship borrowers are those borrowers who do not have any specific banking relationship with the bank. So they are just sometimes called the new to bank customers. And if a region does not have a proper credit bureau, right, then non-relationship borrowers can turn out to be very risky. New to bank customers, right? So, in the absence of credit bureau and absence of any historical, acquisition behavior of the borrower, these borrowers can turn out to be very risky, right? Hence, it is generally seen that it is generally seen that the banks, so as we say that it is generally seen that the relationship borrowers are relatively more preferred than non-relationship borrowers. Right. So this is one of the acquisition segments. I might say, or this is one of the source from where acquisition risk might arise, in terms of affordability, in terms of reliability. Okay. So let's stop here for the day. Let's stop here, and let's continue tomorrow again. In tomorrow's session, we'll discuss more about this non-relationship segment. We will talk about this segment, we'll talk about the non-relationship segment, and when are the times that non-relationship segment is preferred, when not, what is the impact of what possibly could be the impact of incorporating non-relationship segment in the bank, in the model or in the lending process, right? So what type of risk can they exercise? What are the how? So is it possible that the non-relationship segment itself within itself varies in riskiness? So what are the other intricacies of it? So those are the topics that we'll discuss in tomorrow's class, right? And after that, from here we'll move on to talk about the you know the personal loan and the home loans portfolios. Yes.
Okay.
Yeah. Were you asking something, Harpreet?
No, no, I was just saying
Okay,
okay.
okay, okay, okay. Great. Great. So let's meet tomorrow 7 a.m. and we continue the story from there. Thank you.
Okay, thank you.
Okay, thank you.
Bye bye, Suchi. Bye bye, Harpreet.